Enter the dragon and the rate rise era. Before it's time to be an alligator, we must understand the dragon first. According to released data, China is not facing the same inflationary pressures that Europe and North America are currently experiencing. The common thought for the West is to not believe Chinese data because, frankly, it's from China. But upon further research, I will argue that the government of China has done a much better job of controlling inflation than the US, which is about 500% higher than China's today. Let me explain. As I discussed in The Rise of America last year, Xi Jinping and the CPP took on the Chinese tech titans like Jack Ma and cracked down hard on companies and their profits. In almost Putinesque fashion, you can keep the company, but half goes to the state. And make sure your profits do not in any way put any pressure or risk on the national agenda. This kept prices down. The government also cracked down on shadow banking, which slowed the velocity of capital within speculative sectors such as real estate and commodities. Aggressive government intervention in releasing government stockpiles of commodities such as oil, copper, etc. has also tempered any supply issues and price inflation in the near term. But let's take a look at Chinese food. Food makes up 20% of the Chinese CPI index. This will be hard for most to understand, but food prices were lower in China during 2021 than they were in 2020. And thus far in 2022, food prices in China are lower than in 2021. The chart you're looking at right now is the month-over-month change in food prices in China. As you can see, prices have been continuously falling, and just last month fell an additional 6%. Pork is the main protein in China, and pork prices are significantly lower than in the 2020 pandemic highs. Vegetables and eggs are higher, but overall the decrease in pork has reduced food prices overall year over year. The government of China also did not go as wild with monetary stimulus as the US, Canada, and the EU. Combine that with aggressive lockdowns and weak domestic demand, and the inflation situation is lower in China than in US or Europe. But here's why China matters to resource investors. When the dragon sneezes, the resource sector goes into cardiac arrest. It's all about the velocity of capital, and the government of China has really clamped down on Chinese companies purchasing and investing in foreign mining and energy assets. That means less capital flowing into these sectors. Now, let's specifically talk about mining. Cost increases has been dominant across almost all operating mines. In 2020, I wrote about the coming crossflation pressures we would see in many resource projects. Almost all operating mines are experiencing building delays, and many new mine builds are seeing cost blowouts which are not returning the expected shareholder returns. Higher diesel prices and supplies are putting significant upward pressure and will continue to do so for the rest of 2022. But all of that has been known for the last 12 months. None of this was a surprise. The market is currently risk off when it comes to the precious metal equities. That means the actual mining companies. The market sell-off and capital going risk off results in capital leaving the gold ETFs. This results in the ETFs selling the mining share positions to meet redemptions and rebalance their weights. If you are thinking it's alligator time, you are right. We now have specific alligator investing targets, not sector-wide though. I will explain what that means below. With all stocks getting hammered across the board, there is no need to increase your risk exposure to juniors when advanced producing companies are trading at a discount to their net asset value. I am very interested in getting shares of the top quality mid-tiers and majors that are trading at valuations near historic lows. The only exploration gold stocks I want to own are ones with district scale potential, advanced assets, management with skin in the game, and major near-term catalysts that re-rate the stock share price upwards. For example, we have 4 such stocks in the KRO portfolio that have immense upside. I will detail in as much detail as I can what I plan on doing with my own money and show the value propositions. The era of rates, Stormy Waters. The Fed will have to react to higher than expected inflation while juggling market pressures and the looming 2022 midterm elections in November 2022. If inflation continues to rise and affects the bottom line to American citizens by mid-22, the Fed will have no choice but to become reactionary at that point with multiple interest rate increases to tame inflation. Some argue the Fed needs to go heavy up front with the interest rate hikes. Others are waiting for the Fed to ease slowly with their rate hikes. With either option, the odds favor further correction in U.S. equities. Currently, the market is seeing the most aggressive put buying and positions since the depths of the COVID 2020. In February of 2022, over 1,500 companies listed on the New York Stock Exchange and NASDAQ hit 52-week lows. Again, that is the highest number since the COVID lows. That's the chart you're looking at right here. More importantly, the flow of funds from the sub $100 billion to the $500 billion is at its highest rate since the lows of COVID. Since the start of the year, the volatility index, known as VIX, which uses S&P 500 option pricings as a gauge to determine volatility, has averaged a daily change of 0.87% while soaring over 10% in a single day on 9 separate occasions. To put that in perspective, the 5-year average daily change is less than 0.42%. This means that volatility so far this year is over 2 times higher than normal. This gauge suggests that investors are starting to get nervous about their over-leveraged positions, and for good reason. There is no shortage of political turmoil, inflationary concerns, or loose money flying around. I'm not calling a top, but I do believe there is more attention being paid today than at any time in the past 12 months. Investors have begun to realize that the U.S. Fed is going to continue to raise interest rates and taper their asset purchases in the near term. Just last week, the Fed raised their fund rates by 25 basis points to 0.5%. The near zero interest rate and high fiscal stimulus environment, which I call financial heroin, are not coming to an immediate stop, but governments are going to try to slow it down. By slowing the injections of cash and rising interest rates, the U.S. Fed is going to try to contain inflation. This is a situation faced by central bankers and governments of most developed nations. It is safe to say that we are entering into the next phase of this fiscal experiment, and these are uncharted territories. Rate rise ready. Over the next 12 months, market participants, based on the prices they are currently willing to pay for the Fed interest rate futures, are expecting up to 6 interest rate increases and potentially a policy rate of 1.7%. What you're looking at right now is a chart that shows the current expectations for the U.S. Federal Reserve policy rate. While an interest rate of 2.2% may not sound like a lot, I believe it's going to impact trillions of dollars worth of assets and liabilities. In turn, this rate decision will ultimately affect the decisions of other central bankers and the performance of nations' currencies against the US dollar. Now back to the future. If history is anything like the past, most of those other economies will not have the economic strength to absorb many interest rate increases. In today's world, capital is very mobile and moves rapidly across different asset classes around the globe. Investors are always looking for the highest return on their capital. Nations with higher interest rates and strong economies attract investor capital, which in turn increases demand for the currency. Nations who cannot raise rates or see their economies falter in the face of these interest rate increases will ultimately see their currencies decline in value versus those who have strong economies and currencies. This ultimately leads to a stronger US dollar. Focusing specifically on the interest rate movements over the next 12 months, I believe it is highly likely that most developed nations will attempt to raise rates. This means the US will lead the way, and then Canada, Australia, and potentially the EU will have no choice but to follow. As you can see, the downtrend in rates is very clear, but there are periods where there are consistent increases in interest rates. I believe we are on the cusp of central banks implementing one of these steady sets of increases. The trend is your friend. This will have a profound impact on asset valuations and the cost of capital associated with building and holding these assets. So, what to do? Patience. This will not be a quick correction like we saw in 2020 when COVID shocked the markets and the US Federal Reserve came to the rescue. The Fed will not inject stimulus like it did during COVID. Both mining and energy sectors are going to feel the impact of these rate increases. As I prepare my portfolio and picks for the high inflation situation, war and rate hike cycles that are staring at us right in the face, though headwinds are here, are you prepared? Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.